Markets are ripping higher today following the unemployment report and the jobs report that comes out tomorrow. But wait, the markets are actually closed tomorrow. So, what are the expectations for these numbers and what implications could this have to the markets? We're going to talk about that here in this video, as well as the overweighted negative bearish positions on the S&P 500 for next week and for the following week. And these numbers, they're pretty bad. So if you're bullish on this market, you want to watch this video. If you're bearish on the markets, you also want to watch this video, and it might help save you some money and hopefully make you some money in the process. Guys, we're going to get into that as well as everything that is happening here in the markets today. So first things first, markets are up. NASDAQ up over 0.5% here today. Even the Russell 2000 that has been getting absolutely obliterated is up 0.20% on the day. S&P up about 1/3%, and the Dow is up about 0.1%. Volatility also falling about 3% measured by the VIX. Interestingly enough, safety trade assets like TLT is up 0.5% today. That means people are rushing to safety, and if TLT starts to break out above this key level that it's at right now, you can see, let me just paint a pretty picture here, a little trend line, horizontal line for you. If you break out above this level, that's going to show recessionary fears are hitting levels that we have not seen in a very long time. When this chart goes higher, that means yields are going lower. You got to ask yourself, why are yields going lower? Is it because inflation is coming down in a huge way? Is it because the Fed is about to cut rates? Or is it because economic activity is about to slow down and we are very quickly heading into a recession? Well, the latter is most likely, especially since the ADP jobs report was a total failure. The JOLTS job openings was another total failure that came out this week. The JOLTS job openings, we were expecting about 10.4 million job openings. It came in about 600,000 jobs lower than that, at about 9.93 million job openings, showing that the labor market is starting to contract at a very fast pace. Also, we had the ADP jobs report, and that came in about 45,000 jobs lower than what we were expecting. Again, showing the labor market is starting to contract. The biggest problem the markets have right now is if the labor market is starting to contract and economic activity is starting to contract, is inflation also starting to contract? Well, due to the latest OPEC oil cuts and subsequently causing the price of oil to go higher, that not only affects inflation because oil touches everything, right? It has a role to play in every single business. It's going to be a big factor, and it always is a big factor if people raise prices or not, but it also affects inflation expectations. And inflation expectations going higher is directly correlated with the price of oil. And when inflation expectations go higher, well, that's bad for inflation. So that's what we've dealt with the past week, and I think we summarized that pretty quickly for you. Well, today you're getting initial jobless claims that came out, and initial jobless claims today came in at 228,000. You were expecting 200,000, so 28,000 higher than what we were expecting. Now, usually the expectations have been pretty well followed up on over the past couple of months. If you expect 200,000, it's typically came in at like 205,000. It hasn't been a big difference here between expectations and the actual numbers. Well, this last week was a little bit different. You also had Fed Bullard that came out and spoke today at 10 a.m. And one thing that really spoke out and stuck out to me is that Fed Bullard thinks rates are going to have to stay stay high for a very long amount of time, meaning we're not going to get these rate cuts that the markets are expecting. And if we do get these rate cuts that markets are expecting by the end of this year, really by summertime of this year, why would the Fed be cutting rates? I think that's a more important question you need to ask yourself. And it's going to be because the markets, the economy, are likely not in a good place by that moment in time. So that's what also happened today. Tomorrow, 8:30 in the morning, comes in the unemployment rate for March. You are expecting that to hold steady at 3.6%. Not too much else to actually say there. Non-farm payrolls for the month of March, you're expecting that to come in at 239,000, down from 311,000 last month. Now, the labor market is very tight right now, so you can only keep adding so many jobs, but it's going to be the pace of job increases or job losses that people are going to start paying attention to, meaning that if you start to drop by quite a bit, that's not going to be a good thing. For an example, you're expecting 239,000 job ads for the month of March. If that comes in at 100,000, that's going to be bad. That's getting you closer to actual job losses, and that would continue to add to this recessionary playbook. And that's ultimately what the markets have been caring about. The markets have sold off this last week on the JOLTS job openings number that was 600,000 worse than expectations. The markets also sold off on the ADP report, which was worse than expectations. Again, showing the economy is slowing faster than what people were expecting. This is very different than what we've seen during 2022. If this same data were to come out in 2022, where markets seen bad news as good news and good news as bad news, markets would have rallied off of this data we've gotten the last week. It's been quite the opposite here. So if you start to get the unemployment rate going higher, if you start to get non-farm payrolls that are underwhelming, it's going to mean some more downside for this market because, let's be honest, technology is in a bubble. Your Apples, your Microsofts, your Googles, your Amazons, your Teslas, your Nvidias, specifically Meta, Nvidia, Apple, Microsoft. It's very easy to say those names are in a bubble if earnings don't grow. Nobody is expecting earnings to grow. The question is, do earnings hold up or do earnings contract in a larger way than we're expecting? Well, we're going to start to get earnings next week also, and earnings will start to be of the utmost important. Now, also tomorrow, you're going to get the participation rate for March. You're expecting 62.5%. Average hourly earnings month over month, you're expecting that to come in at 0.3%. So to actually go higher from February's number of 0.2%. Average hourly earnings year over year, you're expecting 4.3%, a decline from 4.6% in February. Government payrolls for the month of March to come in at 46,000. Average weekly hours to come in at 34.5 hours. Manufacturing payrolls to go up by about 5,000. Last month's reading, manufacturing payrolls went down by about 4,000. So this data will be massively important heading into next week. Let's switch gears a little bit. Let's look at some of the option activity for the S&P 500 for the next couple of weeks. And let's start with today, because as you guys probably know by now, I said it in the beginning of this video, markets are closed tomorrow. So today is the last trading day of this week. And the open interest on the call side sitting at 37%. Open interest on the put side sitting at 62.81%. And it's been a pretty up and down kind of week. Overall, not a great week, but you are ending off the week, it looks like, on a strong note. Now, for next Friday, that is going to be April 14th. You're looking at calls, the open interest at 28.19%, and puts sitting at almost 72%. Now, you might ask yourself, what does open interest mean? And what are these percentages? What do they mean? Well, call it 100 options. If you had 100 options total on the S&P 500 for next Friday, 28 of those options would be calls, 72 of those options would be puts. And I think that can help you kind of understand. It's the amount of contracts and what side are they on? Are they on the call side? Are they on the put side? That's where you get these percentages, and it can tell you positioning from hedge funds and institutional investors. and could give you a glimpse on what is to come. Now, things get a little darker and gloomier for April 21st, where you have the calls total open interest sitting at 23.5%, and the puts sitting at 76.47%. Now, let's skip to May 19th, because May 19th is going to be where you're going to have your Apple earnings out the way. You're going to have NVIDIA earnings out of the way. You're going to have basically all of your earnings out of the way by May 19th. And that is also another major option expiration where you're going to have options expire. You're going to have futures expire. You're going to have other derivative contracts expiring as well. You're going to have calls open interest 28.21%, puts 71.79%. Considering where the markets are at right now, considering what is happening in the bond market and how overstretched technology seems to be, seems only logical to be a little bit defensive here and to plan some downside protection for your portfolios over the next week or two. Not financial advice. I'm not a financial advisor, but I think that's pretty obvious with the information provided here in this video. It's going to be very interesting though, and we will report to you guys what the unemployment rate comes in as tomorrow, as well as the jobs report. So hit the like button, subscribe to the channel if you learned anything out of this video or if you like my perspectives. Nonetheless, enjoy your extended weekends, and I will see you in the next one.